Your friend just 10x'd their Doge-Elon-Rocket-Lambo coin and you're feeling that primal fear of missing out. Ready to remortgage your pet hamster for a pixelated picture of a slightly bored primate. Hold your digital horses. Before you go full financial kamikaze and YOLO your life savings into the dazzling, disorienting crypto casino, what if there was a significantly smarter, saner way to ride the Bitcoin wave? A battle-tested strategy that lets you tap into its face-melting potential without risking utter financial annihilation when the market inevitably performs its signature move, the bungee jump without the elastic. Forget to the moon or ramen noodles. We're about to unveil the powerful diversification blueprints that could transform your Bitcoin punt into a calculated, robust, and surprisingly stress-resistant investment. Your future, less panicked self will send you a thank you note. Bitcoin. It's the enigmatic rockstar of the financial world. One minute it's headlining global finance news, the next it's in a dramatic public meltdown. It's volatile, it's disruptive. It's hailed by some as digital gold, a hedge against inflation, the future of money itself. By others it's dismissed as pure speculation, a bubble waiting to burst. The truth? It's probably a bit of all of those, and that's precisely why stuffing your entire investment portfolio into Bitcoin is like trying to build a house entirely out of dynamite. Exciting, sure, but one wrong spark and your financial dreams are, well, dust. This is where diversification struts onto the stage, possibly wearing a sensible cardigan but secretly being a financial superhero. It's the age-old wisdom of, don't put all your eggs in one digital, highly volatile basket, but turbocharged for the 21st century. Diversification is your financial shock absorber. It's designed to smooth out the wild, stomach-churning gyrations of individual assets, especially an asset as famously acrobatic as Bitcoin. The goal isn't to eliminate risk entirely. That's impossible if you want any growth, but to manage it, to build a portfolio that doesn't give you a heart attack every time Elon Musk tweets a cryptic dog picture. It's about strategic balance, not blind faith. At the heart of this financial zen is asset allocation. Fancy term, simple concept. It's deciding how to slice up your investment pie amongst different types of assets. And in this pie, Bitcoin is a potent, spicy ingredient. It can add serious kick, but you don't want it to be the only thing on the plate. How much Bitcoin spice you add depends entirely on your personal financial recipe. Your risk tolerance, are you a daredevil or a cautious cat? Your investment timeline, are you saving for next year or retirement in 30 years? Your overall financial goals and even your age. There's no magic percentage, but for most people, especially those new to crypto, starting with a small allocation to Bitcoin within a well-diversified portfolio is the only sane path. Strategy number 1, the classic combo, Bitcoin meets stocks. Think of stocks as the traditional engine room of portfolio growth. You've got variety here. Shares in massive tech companies, stable healthcare giants, everyday consumer brands. You can diversify further with stocks from different countries, your home market, established international markets, even riskier but potentially higher reward emerging markets. How do stocks balance Bitcoin? While stocks have their own roller coaster moments, they are generally driven by different factors than Bitcoin. Company earnings, economic growth, interest rates. Sometimes they move in opposite directions to crypto, sometimes not. The key is, they're not usually locked in a perfect synchronized dance with Bitcoin's every pirouette, offering a degree of counterbalance. A younger investor with a stomach for risk might allocate, say, 5 to 10% of their equity portion to a Bitcoin ETF or direct holdings, while someone closer to retirement might aim for a much smaller or even zero exposure. Strategy number 2. The financial anchor, Bitcoin and bonds. If Bitcoin is the speedboat, bonds are often the steady, somewhat boring, but incredibly reliable cargo ship. Bonds are essentially loans you make to governments or corporations, which pay you interest. They are typically lower risk and offer lower returns than stocks or crypto. Their superpower? Stability. When stock markets and crypto markets are having a meltdown and investors are fleeing for safety, high-quality bonds often hold their value or even go up. They are the financial equivalent of a weighted blanket in a storm, potentially cushioning the blow from Bitcoin's more dramatic price plunges and preserving some of your capital. Strategy number 3, getting real, Bitcoin and tangible assets. We're talking things you can theoretically kick, Real estate and commodities. Real estate, whether it's your own home or an investment property, or more accessibly, real estate investment trusts, REITs, offers the potential for rental income and long-term appreciation. It's a physical asset, unlike purely digital Bitcoin. Commodities include precious metals like gold, often touted as Bitcoin's analog ancestor, a traditional store of value and inflation hedge. Then there's oil, agricultural products, and other raw materials. How do these diversify a Bitcoin holding? They respond to different economic forces. Real estate can be a hedge against inflation. Gold often, but not always, acts as a safe haven during times of extreme market uncertainty or currency devaluation fears. Some of the same anxieties that occasionally fuel Bitcoin adoption. They add another layer of non-correlation, or at least different correlation, to your portfolio. Strategy number 4. The crypto galaxy. Diversifying within crypto. Handle with extreme caution and a hazmat suit. For the truly adventurous, and I cannot stress adventurous enough, with a high risk tolerance and a deep understanding of the crypto space, some consider diversifying their crypto allocation itself beyond just Bitcoin. This means dipping toes into altcoins like Ethereum with its smart contract capabilities or other established projects. The supposed logic? Different use cases might lead to different performance drivers. The brutal reality? The altcoin market is vastly more volatile and risk-laden than Bitcoin. It's the Wild West of the Wild West. Scams are rampant, projects disappear overnight, and when Bitcoin sneezes, most altcoins catch a catastrophic, life-threatening flu. This strategy is akin to juggling chainsaws while riding a unicycle on a tightrope. If you go here, keep the allocation tiny and be prepared to lose it all. For most, sticking to Bitcoin as their sole crypto exposure within a diversified portfolio is more than enough thrill. So how do you actually do this? First, define your target asset allocation. What percentage to stocks, bonds, real estate, and that Bitcoin slice? A common, very conservative starting point for Bitcoin might be just 1 to 2% of your total investable assets, gradually increasing only if your risk tolerance and understanding grow. Then comes the crucial, often neglected discipline of rebalancing. This means periodically, say once or twice a year, or when allocations drift significantly, selling some of your winners that have become overweight and buying more of your underperformers to get back to your target percentages. If Bitcoin has a monster rally and suddenly makes up 20% of your portfolio instead of your target 5%, rebalancing forces you to take some of those incredible profits off the table and reinvest them into more stable assets. Conversely, if it crashes, rebalancing might mean gasp, buying a little more at lower prices, assuming your long-term conviction remains. You can access these different assets through traditional brokerages for stocks, bonds, and ETFs, including Bitcoin ETFs now in some regions, and reputable crypto exchanges for direct Bitcoin purchases. Ultimately, the grand prize of smart diversification isn't necessarily about squeezing out every last drop of potential profit. It's about building a resilient portfolio that aligns with your risk tolerance. One that lets you participate in the incredible potential of assets like Bitcoin without constantly teetering on the brink of a nervous breakdown. It's the sleep-at-night strategy, because financial well-being isn't just about the numbers in your account. It's about the peace of mind in your head.